And joining us now is Schwab Chief Investment Strategist Ann Sonders. Ann, good to see you. So, did you expect to see more tariff impact in the CPI report today, and how significant is it that there isn't more?
So, yeah, I expected a little bit more, although we don't try to forecast CPI, but the fact that it came in pretty comfortably below consensus estimates. Now, I think part of the reason for that is there's such a large shelter component within CPI, especially core CPI, inclusive of the big chunk of which is owner's equivalent rent. And that's been our view, that you were going to continue to see downward pressure on that very heavy weight within CPI, which could serve as a bit of an offset to any tariff goods related kind of inflation. So I think that's a plus going forward. Now, we don't have that higher weight in the Fed's preferred measure, which is PCE, and the components that from CPI that map to PCE suggest we're not going to see as benign a report there. But all else equal, it was certainly a comforting number.
Okay, now backing out to trade, this China trade framework, the progress there, is this good news? Is this solving a problem that maybe wasn't so much of a problem a couple months ago? How should investors think through whether this is good news for the market overall?
Well, I'm glad you called it a framework, John, because it's not really a trade deal. It just lifts what were going to be some restrictions on China's export of rare minerals as well as magnets, and that would have been pretty devastating. So they agreed to continue those shipments. And I guess on the other side of this was the allowance by the Trump administration for Chinese students to join our colleges and universities. So that yes, I mean, we're talking about trade of rare minerals, but I wouldn't call this the kind of trade deal in terms of being a de-escalation from a tariff perspective. The tariffs that the United States has put on goods coming from China back here to the U.S., that hasn't changed. That's still running at an average effective rate of 55%. So better than not getting anything, but this is far from what would be considered a comprehensive trade deal.
So, Ann, in light of all of this, when we have the S&P closing fractionally lower here, it looks like 60.22 as we settle out. Are you surprised to see stocks trading so close to all-time highs?
Not necessarily. I think, none of us can forecast what the headlines are going to be and posts about policy changes. We've learned that those can turn on a dime. I think what's important for investors to think about is not so much trying to anticipate what these policy announcements, escalations, de-escalations, court cases, but what the setup is around some of these catalysts. So, for instance, the setup in advance of April 2nd was one where you got that bad news. There was complacency in the market. That setup meant that the downside was going to be pretty severe. Literally only a week later, when we got the April 9th de-escalation with the delay in the reciprocal tariffs, that setup heading into that news was one of a really dramatically oversold market sentiment that had completely washed out. You were seeing it in fund flows, not just in the attitudinal measures of sentiment. So you got that positive catalyst, and I think the upside was more dramatic as a result of what the setup was. Now, I think arguably with the market having neared all-time highs, a little bit of complacency having come back in, you've got that setup where maybe you're a little bit more either at the mercy of negative news that could be a catalyst, or just you exhaust yourself a little bit because we've already seen that positioning trade. So I think that may be what's reflected in a day like today. Some of that natural, not quite at a high, and then you see a little bit of a pullback. We've seen that time and time again in the course of this bull market.
Another area of focus this week has been just the gargantuan issuance of debt by Treasury as well. We get a 30-year auction, adding to the auctions we've already seen this week. Tomorrow, what is the bond market signaling here?
Well, we've got a little bit more stability. The MOVE index, which measures volatility in the bond market, has come down. And I think that's part of the reason, notwithstanding today's reversal, why the equity market has done well. It's a combination not just of moves up in yields, but speed, but volatility in yields. And I think this recent calm from a yield perspective added to the juice that the stock market was looking for. So I think any kind of calm, limited volatility in the bond market, I think all else equal, is positive for the equity market. But I think a backdrop where we get more volatility in yields, especially if that volatility is driven by the inflation side of the equation, not the growth side of the equation, suggests that any move up in yields, if it's more about inflation, less about growth, would mean probably weaker stocks and vice versa.
Okay, Ann Sonders, it's great to get your insights.